Hello friends, welcome to this video where we will discuss the Union Budget 2024 in very simple and easy to understand language which will benefit students like you who are preparing for interviews and also competitive examinations. Let's start off with the question that you might face in an interview. The financial year is slated to start on the 1st of April, isn't it? So why is it that the budget is presented on the 1st of February? The reason is, once the budget is presented in the parliament and then approval is taken from the parliament, then to set the whole budget process in motion, it will take nothing less than 2 months. So that by the 1st of April, the government machinery is ready to start implementing the proposals which were put forward in the budget. For example, say there is X amount which is kept for the Rural Development Ministry in the budget. So once the budget approval is taken from the parliament, then the finance ministry communicates with the rural development ministry, seeks proposals, notes are put up, processes put in place so that the proper funds for respective projects submitted by the rural development ministry is put in motion. It gets more complex if a new scheme is announced in the budget, then obviously much more time is taken to have a framework for the scheme put in place, the modalities, the rules, so that the scheme is implemented properly, it is communicated to the respective ministry. So everything takes time. So that is why a clear 2 months time is made use of so that there is enough breathing space for the government to use that time to ensure that the entire government machinery is geared up to start implementing the proposals in the budget from 1st of April, the start of the new financial year. Now to two more questions. What is an interim budget? What is a vote on account? During an election year like it is this year, the government does not present a full-fledged budget for the financial year. Instead, the government, the outgoing government that is, will present what is called an interim budget and will seek an vote on account from the parliament. Vote on account is the approval from the parliament which is sought by the government to meet the expenditure for usually a period of 2 to 4 months till the next government takes over. The new government will then duly present its full-fledged budget for the forthcoming financial year. It is expected that the new government will present the budget for the full financial year during early June 2024. Seeking the approval of the parliament through vote on account to meet the expenditure during the interim period is a mandatory requirement as per Article 116 of the Constitution of India. Here I would like to mention that I have done a detailed video about the Indian economy, which will again be very useful for students like you. So suggest you go through that also along with the video on the budget. The link for the Indian economy video is in the description. Now let us understand what the budget is, the constituents of the budget, keeping in mind again the possible questions that can arise. Now if we consider a personal budget or a family budget or even a company budget, it will have two sides, income and expenditure, isn't it? For companies, we call it profit and loss account, where we have the income and the expenditure computed separately, and the difference, hopefully, with income more than expenditure, results in a profit for the organization. Now, in the case of a government budget, we don't use the term income because the government is not earning like an individual or an organization. Instead, the government is receiving money from various sources, like for example taxes, and hopefully spending it the right way for the benefit of the nation. Since the government is receiving money instead of generating income on its own, we use the term receipts instead of income. So in the union budget, we have receipts, that is the money the government receives, and it has expenditure. So instead of saying income and expenditure, we'll say receipts and expenditure. Now what happens is that the government has a lot of expenses to meet, much more sizable than the receipts that it will have. The expenditure will definitely be much more than the receipts, which then necessitates the government to resort to borrowings to plug the gap. So expenditure minus the receipts of the government accounts for the extent of borrowings that the government has to resort to. Now you would have heard the term fiscal deficit. What is fiscal deficit? That is nothing but the extent of borrowings of the government of India. Now why is fiscal deficit a worry? What are the numbers connected with fiscal deficit this year? We'll go into that later. Now let us understand the terms receipts and expenditure in a bit more detail, which will help us to answer a couple of more questions connected to that. Receipts of the government can be split into two parts, revenue receipts and capital receipts. Now what are they? Revenue receipts are those which are recurring in nature. Capital receipts are those which are non-recurring in nature. What will be an example of the revenue receipts which immediately come to mind? Recurring in nature? Taxes, isn't it? Capital receipts, non-recurring in nature. Example would be the proceeds from disinvestment, that is selling of shares of public sector undertakings. The expenditure of the government again is split into two, revenue expenditure and capital expenditure. Now it's easy for you to understand these two terms, isn't it? What will be revenue expenditure? Expenditure which are recurring in nature. Example, pensions, salaries of government employees. Capital expenditure are those which are non-recurring in nature. For example, investment in building infrastructure, roads, rail network, airports, sanitation facilities, housing schemes, drinking water facilities and all that. To make you understand in very simple terms, let me give you an example. Let's say the government is buying a vehicle for a senior government official. The expenses for buying the vehicle is a one-time expense. It is a capital expenditure. Paying the salary of the driver would be termed as a revenue expenditure because it is recurring in nature. So I hope you understand the terms revenue receipts, capital receipts, recurring, non-recurring respectively. Revenue expenditure, capital expenditure again, recurring and non-recurring. Now if you look at revenue expenditure and revenue receipts, usually the revenue expenditure, the payment of salaries, pensions, etc. are much more than the revenue receipts. So revenue expenditure minus revenue receipts is called revenue deficit. Now let us look at from where does the government receive money? How does the money come into the kitty of the government? Majority of the receipts are through taxes. Various kinds of taxes. Income tax contributes to 19% of the total receipts of the government. Then we come to corporation tax, which means tax paid by corporates, companies. So that constitutes 17%. GST 18%. Union excise duties mainly on petroleum products 5%. Customs duty levied on import of goods into India 4%. So together the total taxes levied comes to 63% of the total receipts of the government of India. So there is no escape from taxes, isn't it? Because that's a major contributor to the government's kitty. So there'll be questions like which are the taxes which contributes to the receipts of the government, which taxes are the major contributors. Another possible question is what are direct taxes and what are indirect taxes? Direct taxes are those taxes where the liability to pay tax cannot be passed on to somebody else. For example, income tax, the individual has to pay. Corporate tax, the company has to pay. The liability cannot be passed on to somebody else. So, income tax, corporation tax are examples of direct taxes. Now, what are indirect taxes? Those are taxes where the liability to pay tax can be passed on to someone else. And who can that be? That is a consumer. Example would be GST, where if you buy a product, let's say you're buying a new car, for example, or you're buying a toothpaste, you pay GST, isn't it? The car dealer or the shopkeeper, whatever the case may be, would collect the GST from you and pass it on to the government of India. So these entities are just collecting the taxes from the consumer on whom the liability has been passed on to pay the tax. I would like to specifically mention here that agricultural income is not subject to tax. Now let us look at the other kinds of receipts. Non-debt capital receipts, 1%. Non-debt, which means it does not put the government under any liability, and it is through sale of capital receipts, which means a prime source is the money received through disinvestment. Non-tax receipts, 7%. Examples would be dividends from public sector companies, toll paid on national highways, fees paid for entry to national parks and national monuments. Then we come to a major item, borrowings and other liabilities, which is a whopping 28% of the total money that is coming into the government kitty. And we talked about fiscal deficit, which is nothing but the extent of borrowings of the government of India, which is required to meet the expenditure, which is always more than the receipts through taxes, non-tax revenue and non-debt capital receipts. So the gap is plugged through borrowing. The estimated borrowings of the government of India for the coming financial year 2024-25 is a whopping 16,85,000 crores. 16,85,494 crores to be exact. No need to go into specific figures while discussing the budget. Approximate figures, which I'll be quoting, that will be enough. Now you can easily understand, looking at the pie chart, why fiscal deficit is a major concern of the government of India. Now, during 2023-24, the fiscal deficit of the government of India is estimated to close at 5.8% of the GDP. In 2024-25, the government estimates the fiscal deficit to come down to 5.1% of the GDP. Now there is this very important act which was passed in the parliament called the Fiscal Responsibility and Budgetary Management Act of 2003, which stipulates that the fiscal deficit should be maximum 3% of the GDP, not more. But then it has never been achieved, because over the years, at various points of time, one government after the other had various contingencies to meet, which necessitated expenditure going beyond limits, with the government ending up borrowing much more than what was desired. For example, recently, due to COVID, the government had to increase their expenditure on food security, making additional expenditure provisions for reaching food to the population who were without work because of COVID. So during 2019-20, the fiscal deficit went for a 6. So during all these years, the government will then seek special approval from the parliament to pass the budget with the excess fiscal deficit in place by citing the contingencies that they had to meet. Now let us look at the expenditure side of the government. What does the government spend on? Let's start with this item called central sector schemes. Now these are schemes which are planned and implemented solely by the government of India. For example, metro projects, Ujjwala scheme, which is for providing LPG connections to poor households, Mudra Yojana, which is for loans to entrepreneurs, Swasthya Suraksha Yojana, which provides insurance cover to meet ailments and injuries through accidents. Another example would be Khelo India. So a variety of programs which are implemented and funded solely by the government of India. Then we come to centrally sponsored schemes, which are schemes formulated by the government of India and implemented through the state governments. The funds for these are shared between the Government of India and the state governments. It can be to the tune of 90% for the Government of India, 10% for the states, can be 75, 25, 60, 40, can be even 50, 50. So it depends on the nature of the projects. Examples would be the Pradhan Mantri Gram Sadak Yojana, PM Awas Yojana, which is a housing scheme implemented both in urban and rural areas. Manrega project, which means Mahatma Gandhi National Rural Employment Guarantee Program. Programs on Green Revolution, White Revolution, Blue Revolution, which means work done on aquaculture. Swachh Bharat Mission, National Health Mission, National Education Mission, and so on. So centrally sponsored schemes are schemes which are formulated by the Government of India and implemented in association with the state governments. Then there is expenditure on subsidies to the tune of 6%. There are three major kinds of subsidies doled out by the Government of India. Foremost is food subsidy, followed by fertilizer subsidy. To a very small extent, there is also petroleum subsidy. These three together is to the tune of 3,81,000 crores. Food subsidy is mainly for funding the Pradhan Mantri Garib Kalyan Anna Yojana, which is for providing subsidized food grains and also free food grains for targeted population in India through the public distribution system, which means ration shops. Fertilizer subsidy is for supporting the farmers to make fertilizers available at controlled prices. The major part of the fertilizer subsidy is spent on urea. Expenditure on defense constitutes 8% of the total expenditure of the Government of India, which is a necessity thanks to some of our friendly neighbors. The total defense budget is 4,55,000 crores. Now let us come to Finance Commission and other transfers, which contributes to 8% of the total expenditure. These are grants given to Gram Panchayats, urban local bodies, and also includes grants given to the states in times of national calamities like flood, for example. Currently, the Government of India is following the proposals put forth by the 15th Finance Commission headed by Shri N.K. Singh, and that will be in vogue till 31st of March 2026. The government has already constituted the 16th Finance Commission, and that is usually done 2 years in advance because it will take that much time for the Finance Commission to have their sittings and come up with their recommendations, which will then be implemented from 2026 for the next 6 years. The 16th Finance Commission is headed by Shri Arvind Panagarya. Now, one of the major roles of the Finance Commission is to put forth guidelines for sharing of taxes between the center and the state governments. So as you can see, the state's share of taxes and duties contribute to 20% of the government expenditure. Now, why should the central government share a portion of the taxes collected with the state governments? The reason is that a lot of taxes are collected directly by the central government, isn't it? For example, income tax, corporation tax, that is the tax paid by the corporates, customs duty, central excise duty, IGST component of GST. So, for example, a person might be residing in, say, Tamil Nadu or Punjab or West Bengal, but his income tax is collected directly by the central government. A company might be based in Karnataka, can be in Maharashtra, Gujarat, Delhi, but the company pays corporation tax directly to the central government. So the central government collects a lot of these taxes directly and then shares a portion of that with the state governments. Now, as per the 15th Finance Commission recommendations, 41% of the total taxes collected by the Government of India is shared with the state governments. Pensions contribute a significant 4% and other expenses would be 9%. There's one item which stands out here, isn't it? Interest payments. Interest payments on what? On the borrowings made by the Government of India. In the earlier slide, we saw that out of every rupee earned by the government, 28% is contributed through borrowings. Now here in the expenditure chart, we can see that the interest component is a significant 20% of the expenditure. So on one hand, the government is receiving 28% out of the rupee through borrowings, and on the other hand, the government is giving out 20% of the rupee to meet the interest payment. So in essence, only the remainder 8% is what the government gets to actually spend, isn't it? The more the government borrows, the more will be the interest payment. So that is why the government always strives to reduce the extent of borrowings. That means reduce the fiscal deficit. Now here is another term for you. That is primary deficit. What is primary deficit? Borrowings minus the interest payment. That gives you primary deficit. So we have talked about fiscal deficit. We also talked about a revenue deficit, didn't we? And now we have covered primary deficit. Now friends, let us run through some of the announcements made in the budget. Now since this was an interim budget, no big ticket announcements were made because morally the outgoing government should not be making major announcements because it's up to the new government to set the roadmap for the next financial year. But still some announcements were made, so let us run through them. One of the major things to look forward to in a budget is the amount which is allocated for capital investment in building infrastructure. Now ideally, we should like the capital investment to be very high. Now to understand this in very simple terms, let us look at our own personal budget. Now we'll spend on a lot of items. For example, we'll spend on clothes, we'll spend on eating out, going for a movie, going to a shopping mall, isn't it? At the same time, we'll also spend on accumulating assets. For example, buying a house, buying property, buying a car. Now each time you do that, you are building up your assets, isn't it? Now we would like to have a good mix of both. But then think of it. Out of say 100 rupees of income that we have, we spend 98 rupees on lavish expenditure and only 2 rupees on asset building. That's not good, isn't it? So similarly, a nation also should spend a significant portion of the expenditure for asset building. So that is why capital investment on infrastructure, which means building roads, airports, seaports, metro rail, rail networks, telecommunication, housing schemes, drinking water facilities, hospitals, healthcare, sanitation facilities, and so on. Capital investment on infrastructure results in significant generation of employment, which means salary generation, which in turn means money coming into the hands of the workers who would then spend money for their requirements. That generates demand for various products, which will result in additional production, which again leads to more jobs being created, more money again in the hands of the workers. So there is a trickle down effect in the economy where the money reaches to the lower strata of the society. In this budget, the total expenditure which has been set forth for capital investment is to the tune of 11.11 lakh crores, which is up 17% as compared to last financial year. This expenditure constitutes 3.4% of the GDP. In addition to this, the Government of India also gives grants to the various state governments for projects for asset building. So these grants for capital investment which are implemented by the respective state governments is to the tune of 3.85 lakh crores. So together, adding these two amounts, we get a total of 14.96 or let us say 15 lakh crores, which is for capital investment, asset building for the nation. So these are investments made for the present and the future generations. Now the total budget expenditure is 47 lakh crores. So if you look at 15 lakh crores, out of the 47 lakh crores expenditure of the budget, it constitutes to just over 31%. Now that looks impressive, but then let's understand that from the context of our example of personal expenditure. Out of 100 rupees which is spent by the government of India, 31 rupees is spent on asset building. The remaining 69% is not contributing to infrastructure development, isn't it? Now these are spent on interest payments, spent on salaries, spent on pensions, also spent on subsidies and so on. In addition to this, the government of India has a corpus fund in place to the tune of 1.3 lakh crores to provide interest-free long-term 50-year loans to the state governments to implement capital expenditure projects. A significant announcement relates to rooftop solar scheme, which promises to reach out to 1 crore households in India, which will help them to obtain up to 300 units of free electricity every month. A significant announcement is regarding the drive of a vaccination campaign against cervical cancer by vaccinating girls in the age group of 9 years to 14 years. Health insurance cover under the Ayushman Bharat scheme will be provided to ASHA workers, Anganwadi workers and helpers. These are people who do thankless work at the real grassroots level. The government has allocated 80,000 crores for the housing scheme PM Awas Yojana, which has two components, PMAY Gramin and PM Awas Yojana Urban. The government claims that under the Gramin scheme, close to 3 crore households have been provided, and over the next 5 years, the target is to provide for another 2 crore households. A promise has been made in the budget to launch a housing scheme for the middle class. There are no new income tax proposals in the budget. The finance minister claims that as per the new income tax regime, which was put forth in the budget last year, individuals who have an annual income of up to 7 lakhs have no tax liability. In a budget speech, the finance minister stated that there are a number of income tax claims which have not been settled over the years, and some of them date as far back as 1962. So she has announced the one-time amnesty scheme wherein all the income tax demands up till rupees 25,000 will be waived off up to the period 2009-2010. And then for the period 2010-11 to 2014-15, the finance minister stated that all disputed income tax demands up to rupees 10,000 will be waived. She claims that the benefit of the entire amnesty scheme will cover about 1 crore taxpayers. Students who are preparing for IRMA interviews, please note that in the budget, the provision for agriculture and allied sector is to the tune of 1.27 lakh crores. Let's look at the allocation made by the Government of India for their biggest 9 schemes. The highest expenditure that the government incurs across various projects is for the Pradhan Mantri Garib Kalyan Anna Yojana, which is the food security program to reach food grains at subsidized rates and also free of cost to the targeted audience, which is touted as the biggest food security program in the world administered through public distribution scheme. 2,05,000 crores. Then 86,000 crores for the Manrega program, Mahatma Gandhi National Rural Employment Guarantee Program. Housing scheme, PM Awas Yojana, 80,000 crore for providing quality drinking water. Jal Jeevan Mission, 70,000 crore. Then PM Kisan program, which provides for financial support worth rupees 6,000 to targeted farmers identified by the state governments. The 6,000 rupees to the farmer is given in 3 equal installments during a year. 60,000 crores allocated for that. National Health Mission, 38,000 crores. National Education Mission, particularly targeting primary education up to the 12th standard, 37,500 crores. 21,000 crores for the Saksham Anganwadi and Poshan 2.0 scheme, which is a nutritional support program to combat malnutrition among children, young girls, pregnant women, and lactating mothers. The last one we are going to talk about is the Pradhan Mantri Gramin Sadak Yojana for building roads in rural areas. 19,000 crores allocated for that. Appreciate your time. Hope my insights were valuable and you benefit from my expertise. Catch the next video in our GD interview mastery series for MBA aspirants. The link is in the description. Stay tuned for more success tips.